Welcome to The Explainer. Today, we're completely deconstructing an institution you interact with literally every single day, but you've probably never seen from the inside. We're going to rip the roof off the banking industry to expose the hidden, highly leveraged, and honestly, sometimes terrifying mechanics that keep the global economy spinning. Okay, let's dive into this. The dream of owning a bank sounds absolutely incredible, right? People literally walk in the door, hand you their money, you turn around and lend it out to someone else at a higher rate, and you just sit back and effortlessly collect the difference. Boom, you're rich. But as we're going to see today, the staggering, volatile reality of this business is a whole different ballgame. Section 1. The Vault Illusion. So we need to challenge a fundamental assumption you probably have about what a bank actually is. Think about a normal business, right? Like a bakery. A bakery buys flour, bakes it into bread, and when they sell that bread, the flour is gone. But a bank doesn't work like that at all. A bank takes your deposits, that's its raw material, and turns them into loans. But here is the mind-bending part. When they lend your money out, your deposit doesn't actually disappear from your point of view. You log into your banking app and boom, your money is still completely visible in your account. The bank has magically turned other people's money into credit, all while maintaining this perfect illusion that your cash is just sitting peacefully in a little metal box with your name on it. And you can see how this builds into what we call fractional reserve banking. This is literally the foundation of the modern economy. Let's walk through it. Step 1, you deposit $100. Step 2, the bank keeps a tiny fraction of that in reserve, historically, let's say $10. Step 3, they lend out the remaining $90. Now, that borrower goes out and spends the $90, which then gets redeposited by someone else in step 4. And the cycle just keeps going. Your original $100 eventually cascades into $900 to $1,000 circulating out there in the economy. It is practically legal magic. Now, it's worth noting the U.S. actually eliminated that strict 10% reserve mandate back in March of 2020, but the foundational math and the sheer power of that multiplier effect remains exactly the same. Section 2. The cost of admission. Starting a bank is incredibly difficult. You don't just lease an office building, put up a fancy sign, and call it a day. No way. You need a federal or state charter, FDIC insurance applications, and 1 to 3 years of intense, grueling paperwork before you even hit day one. And crucially, to start even a small community bank that makes maybe $100 million in loans, you're going to need $10 to $15 million of your own personal capital. Now, keep in mind, capital is not deposits. It's your own money acting as a loss cushion. And the regulators at the FDIC absolutely will not let you open those doors without millions of it and a pristine business plan. And the expenses definitely do not stop once you open. Actually, they explode. Get this. JP Morgan Chase spent over $22 billion on non-interest expenses in just a single quarter of 2024. Think about that for a second. That is literally enough money to fund a space program. We're talking about astronomical fixed costs, draining money every single day. Massive payrolls, intensive cybersecurity to fight off constant hacking attempts, literal armies of compliance officers, and loan loss provisions. All of this has to be paid out before a single dollar of actual profit is realized. Section 3. The profit engine. So once you're running, the absolutely crucial thing to understand is the net interest margin. Basically, the bank sits squarely in the middle of the money flows. They borrow money incredibly cheaply from depositors like you and me, maybe paying a tiny fraction of a percent on a savings account, and then they turn around and lend it out expensively to borrowers for, say, a 7% mortgage or a 20% credit card. They sit there and collect that lucrative spread. And of course, they supplement this core engine with an absolute arsenal of extra charges, overdraft fees, card interchange fees, wealth management fees, the whole shebang. $58 billion. That was JP Morgan Chase's net profit for the year 2024. That is the highest annual profit in the entire history of American banking. When you take those tiny margin percentages we just talked about and multiply them across trillions of dollars in assets, it cascades into entirely inconceivable wealth. Section 4. The leverage trap. All right, here is the major turning point. The exact same mechanism that makes banking uniquely profitable is the precise thing that makes it uniquely vulnerable, and that is leverage. Banks operate almost entirely on other people's money. A bank might hold $50 billion in deposits, but only have $5 billion of its own capital equity. Because they're so highly leveraged, a relatively tiny 10% drop in their asset values completely wipes out that $5 billion equity cushion. Instantly, just like that, the bank is technically insolvent. Let's put that into perspective for our hypothetical startup bank with $15 million in capital. A good year with a 3% net interest margin yields a pretty tidy $620,000 profit. Not bad, right? But what happens in a bad year? Well, if a committee in Washington raises interest rates by just 2%, suddenly your margin compresses to 1.5%. Now you are bleeding money every single month. Just 2 bad years like this can effortlessly consume 27% of a community bank's total capital. The margin of error here is razor thin.
Section 5. Anatomy of a collapse. To really understand the terrifying speed of a bank collapse, let's compare two of the most spectacular failures in financial history. Kerry Killinger spent 17 years building Washington Mutual into a massive giant with $188 billion in deposits, only for it to be utterly destroyed in just 10 days when their subprime mortgage bets went sour in 2008. 10 days. But now, compare that to Silicon Valley Bank. They operated successfully for 40 years, amassing $209 billion in assets, and they were wiped out in just 44 hours. It just goes to show that even massive, deeply experienced institutions are fatally fragile.
So how exactly did a 40-year-old giant die in less than 2 days? It was a classic asset-liability mismatch. See, during the tech boom, SVB's deposits doubled to a staggering $124 billion. They took all that cash and did what seemed perfectly responsible at the time. They invested heavily in technically safe long-term government bonds. But when the Federal Reserve aggressively raised interest rates in 2022, the market value of those long-term bonds plummeted. Suddenly, SVB was sitting on $17 billion in unrealized losses. Their perfectly safe investment became a fatal trap. And then, the panic set in. March 8, 2023. SVB announces a $1.8 billion loss while trying to raise capital. March 9th, a highly concentrated group of venture capitalists see the news. Group chats go live. Panic spreads at the literal speed of a text message. Everyone rushes to pull their money out simultaneously. By March 10th, it's over. The government seizes the bank. 44 hours. $42 billion. Just let that number land for a second. Imagine a quarter of your own bank account vanishing before you even have lunch. On a single day, March 9th, customers attempted to withdraw $42 billion from Silicon Valley Bank. That was nearly a quarter of the bank's entire total deposits, just vanishing in a matter of hours. There is no capital buffer in the world that can survive that kind of velocity. Section 6. A machine built on trust. It all brings us back to one core, honestly terrifying takeaway. When you own a bank, you're buying a machine that turns trust into money, and it runs entirely on the assumption that the trust never runs out. A bank can be mathematically, technically perfectly solvent in the morning and be utterly destroyed by the afternoon, not because their underlying business changed, but simply because confidence evaporated. So I'll leave you with this provocative thought as we wrap up this explainer. You've seen the vault illusion, you've seen the leverage trap, and you've seen the breakneck speed of a collapse. When a machine is fueled entirely by other people's trust, what happens the moment everyone asks for it back? Thank you so much for joining me to uncover the hidden economics of banking. Keep questioning the mechanics behind your everyday reality, and I'll catch you next time.